I am now short the stock market. I opened up a new position early this afternoon when the market started to head higher. I am not using leverage, so it's okay. I'm not too deeply into this trade. But think about it. The tariffs argument is always going to fluctuate up and down. But what has not changed is that this is a bear market, that the underlying technicals of this bear market started back in mid-September, and bear markets do not end in a matter of an hour and a half. And other than, the tariff argument up and down, nothing is any different. My research continues to tell me that in the coming weeks to months, the stock market could be down, well, at this point now, another 20 to 30%. And that's why I opened up that short position. So I think I am going to be very happy with that short position. It was a gift, in my opinion. The rally today allowed for 3 huge opportunities, in my opinion. Number one, like I already discussed, to enter a new short position at a really, really nice price. Number two, if you think along with me that this is a bear market and that prices will be much lower in the future, and if you have so far ridden down on the roller coaster of hell, this stock market, it gave you a much better opportunity to get the hell out. And number three, it is also allowing for the institutions that manage just billions and billions worth of dollars of investments to get out. The mom and pop investors, in my opinion, were the buyers today. It's not the institutions. The institutions are using you probably as leverage, as liquidity. The mom and pop investor, because the institutions will now start to sell out of this rise in price. They're looking at it as a gift where they can get out and sell. Be careful, mom and pop investors. This is not investment advice, and if you don't know me, I'm John Crocker, professional investor, proud American, cigar lover, and owner of Crocker Capital, LLC. The 10-year yield has absolutely skyrocketed over the last 3 days, and you've heard me say many times in the last few weeks that in a bear market, in a weakening economy, which we are in, increased interest rates are generally a good thing. So we have a confirmed breakout now on the 10-year yield above 4.20%. We're looking at an unconfirmed breakout above 4.32%. Now, normally this would be good news. Here's why, to me, this is actually bad news. I believe there's 2 things happening here. Number one, dictator Xi over in China wants to screw over Trump all he can, and the Chinese are selling U.S. treasuries. When bond prices fall, treasury yields go up. Treasury yields going up is the opposite of what Trump wants. Trump wants lower yields so they can restructure all of the unsustainable debt we have that we've accumulated over the last 4 years at lower interest rates. Well, when those interest rates go up, we can't restructure that debt. That's one thing that's happening. The other thing that's happening is called the basis trade. Let me understand, and I'll just say ahead of time, A, thank you to the Kabasi letter for all the things I'm about to share with you, and B, I don't completely understand this myself. So these huge money management institutions, as normal business practice, are going out there and they're buying U.S. treasuries, as they always do, and they are also buying and selling U.S. Treasury futures. Now, the interesting part about this is the futures and the prices. There's usually a little price gap between the Treasury futures and the Treasury themselves. And in a low volatility stock market, these very smart men and women can use that little price gap between the Treasury futures and the Treasuries themselves to do a little bit of arbitrage and possibly make even more money. Where it gets really, really hairy is these institutions sometimes are using 100 times worth of leverage when they buy these treasury futures, and in a very volatile stock market, it can go wildly against them. This basis trade could involve $800 billion worth of these treasury futures. When asset managers and hedge fund managers when they buy billions of dollars worth of these Treasury futures and then interest rates fall and Treasury future trades go against them, and then they choose to sell them, well, somebody has to provide the liquidity. Somebody has to buy these Treasury futures in the marketplace. For now, anyway, these brokerage houses are providing that liquidity, but $800 billion worth of unwinding, that's a lot of cash they have to put up. That $800 billion actually equals about 40% of the prime broker's cash, and absorbing that is just a huge shock to the system. So you might think that the increase in yields here is a good thing, and it's a risk-on scenario that, oh yeah, people are selling treasuries so then they can buy stocks. No. People are selling, these institutions are selling treasuries like crazy, and that is jacking up the yields. It is also why gold is taking off. So I actually see the huge spike up in gold today as being bearish for the economy and the stock market, again, because President Xi in China is selling their treasuries, trying to jack up those yields. And then here at home, with $800 billion worth of treasury futures being sold, that is also jacking up the yields. It's scaring people, and they went to gold today. Be careful. So absolutely, I started a new short position today because here on the S&P 500, the SPX, not only did we even exceed the high dead cat bounce level of about 5,301 that I've been showing you for days, we even, as of 2:32 in the afternoon, have an unconfirmed breakout on the S&P 500 above the $5,353 level, not dollars, but points, you know what I'm saying. So again, I think this is a gift to those who understand, and I went short today. The NASDAQ 100 QQQ shot up huge today as of 2:26 in the afternoon. I mean, we have unconfirmed breakouts above 425, 438, and 451. I don't trust it. I get it. I can be wrong. You think I'm nuts or you think I'm right? Let me know in the comments.